Hi everybody, we're continuing this week with next part of equities, and as I said before last week, I want you guys to focus in this month on learning how to do equity valuation. I will have you guys also read the book and go over options for the week, and at the same time I want to continue focusing on the model as well. So I will have a few questions for you guys for the options as a homework assignment, something very light for you guys just to read the book, go over the chapters, and have a little bit of a review. And I will also mostly focus on this and the project as well of continuing to build your model. As I just know from industry practice that this piece is actually very important, and the other piece is part of our curriculum, and I just want you to read it. So, with continuing our Nike valuation, what I wanted to go over is, first of all, I think we did this last week, but just to pick up, I want you guys in your models to basically reverse engineer the growth rate so that your value per share matches what the current stock price is. What do I mean by that? If I have a growth rate of 5.0 in this model here, then my Nike price, this is for Nike, my Nike price is 52.1 and the stock is trading right now at 49.9. So we have 49.9 here, and so I'm off by a couple bucks. So basically, if I say, hey, is the growth rate 6%, then I'm actually going up to $65 per share, and the market is saying no, it's 49.9. And what's the difference is basically what I'm off by. So it must be the growth number, right? It must be the growth number. And it's basically saying, hey, you're actually saying something, hey, something people don't believe. Right now, the market, which is an aggregate of everybody out there, analysts and actual traders, are indicating that the growth rate is what? So I actually played around, and this is what I want you to do. Play around and see, oh, hey, 4.9% gives me $1.7. If I go 4.3%, I'm actually now lower than the price, so it must be a little bit higher. 4.7 is good enough. We're very close now. So I want you guys to basically reverse engineer this, because now you know what the market is perceiving. Now one might say, hey, how do you know the growth rate controls most of the stock price? Well, look, if our stock price is the combination of these three values, the book value, the discount of earnings for the next couple of years, and the continuing value, what percent is which is which? So if you look here, 18% of the value comes from the book, or basically, well, essentially we're saying, hey, that's their Nike's assets. They have power plant equipment, property plant equipment that basically have a brand and things like that. That's literally on the books, which is audited, so that is worth $8 a share, $9 a share, 18%. 12% we're discounting earnings, literally bringing in the earnings, which I will go into. But if you look at their earnings, essentially we have a net income of several $billion a year. So provided that's continuing, we're literally discounting what is already forecasted, and that's another 12% to the value, because that's cash flows. But look, most of the value, I want to highlight this, 71% comes from the continuing value. What is the continuing value? I know you did it in your models, but just to review one more time, because this can be a little nuanced. I will also upload the spreadsheet to Teachable, so you guys have this. I update this on the new model to make it dynamic. So I want you guys to do the same so you can play with this. I know it was hard-coded last time, but now everything is basically dynamic, so that the moment you change the growth rate or the discount rate, everything changes, and it shows you the new difference, the stock price and everything. So I want you to update this number as well, I'll put this in yellow. Basically for you, update with your stock price, and this reduced to near zero, because I want you guys to, within like 1.1, don't play around with it too much, so that you reverse engineer it, and basically this you can update to match the market. And right now with discount rate, don't touch it. This we will do next week on approximately the 14th, 15th. I'll release the lecture. We will go over how, just a little preview, we'll go over how what happens to the stock price when the discount rate changes. And this I'll go over a little bit more. Very interesting sometimes, because what if the Fed raises rates by 2-3%? The market premium will have to rise on all stocks. And how does this impact? Of course, we're discounting by higher values actually. And you notice, if you of course you know, I mean, if you know the market, when rates go up, market comes down. When rates go down, markets go up. And this is, it's nothing to do with actual stock trading. It's nothing to do with what we talk about today, which will be profitability. But this has to do with the discount rate, the cost of capital, essentially. And when rates go up, people prefer bonds, obviously, because it's safer. So we'll go into that. That will be next week. So don't touch right now, but you can play with it a little bit just to see initially what happens if it's 10%, what happens if it's 8%. You'll see big changes, which we may see now that there may be an economic cycle starting, which some people are saying next year. Hopefully not. So this is the piece. I just wanted to introduce this. I will upload the file, and I will create another video, and in the next video we'll go over the profitability pieces with Nike.